Hi everyone, welcome back to the YouTube channel. I'm particularly excited about this and I love talking about money, growth and everything like that. And what I want to talk about is how to grow an investment portfolio, when to diversify, how to risk mitigate and how you can approach it in the right way. And this is covering both property investments and other investments because ultimately we want a wholesome, diversified and growing portfolio helping you grow in 2021. Now, if you're interested in property, growth, mindset and business in general, then this is definitely the channel for you, and I'd absolutely love it if you could just take 2 seconds of your time to smash that subscribe button, make sure to hit the notification bell, and of course hit like on this video for the YouTube algorithm. So let's jump into 10 steps that I think is going to really help you grow your portfolio. Is this all inclusive? Does this cover absolutely everything? Of course not, but these are the top 10 things I think you should be taking account of to start growing your investment portfolio. Number one is, I know you really can't help this if you're older, by the way, but the younger you invest, the easier it is. Just to show you some examples of some numbers to go through this so you can really visualize how much easier it is if you're starting young. We'll go to the board now. So what I've written up on the board right now is everything you will need to invest if you want to retire, let's say at 65, and really this is just a representation of how much you need to invest on a monthly basis. And I'm going to do a deep dive video around this separately, and I'm going to give you a spreadsheet where you can break down these calculations for yourself at your age, the rates, etc. So that's coming up. So make sure you are subscribed to this channel if that's something you're going to be interested in seeing. So at 25 years of age, and what we've made the assumption of at the moment is all of these are monthly investment amounts, and we are assuming a fairly modest return of 7%. Now that's a strong return, but it is something that's perfectly feasible over the long term. So a 7% annual return on this. If you are 25 and you have 40 years to invest, you need to invest £380 a month in order to retire a millionaire. Okay, a net worth cash millionaire when you retire at 65. When you're 35, that more than doubles to 819. Still manageable. We can still do that and build up our investments. At 45, it's at 1,919. And then at 55, we've only 10 years until, if you want to retire at 65, 5,777. Now, if you are watching this channel at any age, I can show you how to become financially free and become a millionaire, even if you are 55, 65, 75 or onwards, okay? I'm simply showing you that as a simple rate of return at 7%, invest in your own money. Look how much that this accelerates over the long term on that. I'm going to leave this up just in case you want to take a photo of that separately. Now's the time to do it, okay? But invest as early as possible. So number two, and we're going to bring this up on screen in front of me, is diversification. So I strongly recommend that you do not over invest in any part of your portfolio. And what I'd recommend is never having more than 20% of your investment in any one asset class. And I'm going to bring this up to show you exactly what I mean with how I move forward. Now, a caveat to this, if you're starting out with £1,000 and building that up, obviously you're not going to split that down and split it and split it and split it. But what I would recommend is aiming for that as you are moving forward. Okay, so here's my asset classes. So number one, I allocate 20% of my investment towards loans. Typically in the property space, I will lend out my money to other individuals. It feels really good because it's helping them build their portfolio, and hey, I make a really great return on my investment as well at the same time, giving value and receiving remuneration for that. Number two is I invest around 20% of my money into startup companies. So these are tech companies. I really like fintech and prop tech companies mainly. Technology companies based around the industries that I understand mainly is what I want to invest in. And I really enjoy doing that because again, it's helping small companies. A lot of them fail, obviously, as is the nature, and I lose a bit of money. But the ones that really do make it end up making quite a lot more, that more than cover the risk that I like doing. High risk strategy, don't recommend it for most people until you've got a decent amount of money behind you. Number three, 20% of my investment, and I'll be honest with you, this does actually represent more than 20% of my investments right now, is property. I am obsessed with property. I absolutely love it. I think it is one of the best multipliers of your money that you could put your investment into, because it gives so many outs with the rental, so the cash flow that's coming in, and of course the capital growth. On average, since 1066, it's doubled in every 10 years, give or take, and that's just looking to continue into the future. So absolutely love it, but 20% of my portfolio is property investment. So the next 20%, I'm going to break this down a bit more in a moment, is stocks and shares. Okay, I love investing it into the bigger companies as well. They're typically more reliable, and there's a few ways of doing this. One of them is by following an index such as the FTSE 100, 250 or 350. Or you can invest in individual stocks. I'm going to touch more on that later, but I do really like them, and I like a mix of dividend stocks, i.e. stocks that aren't really going up massively in value, but they give regular payouts, or I go for stocks that don't have dividends, but I think they've got massive growth potential in that. And then finally, in this 20%, I called it my breakdown, okay? And this is a mixture of alternative coins, so things like Bitcoin and stuff like that. That represents around 5% of that 20%. I've got cash investments that represents another 5%. Material, so gold and silver predominantly, or broken down into that. So titanium I invest a lot in as well. I know it's a bit of a weird one, and platinum. And then finally a 5% allocation to gold investments. So why do I diversify in the first place, doing all of that? Well, it's all about hedging your risk. So remember, building wealth, and people don't really think about this, it's about the preservation of capital. And you want to write that down, the preservation of capital. We're trying to beat inflation. That's it. Okay, and everything on top is a win. But ultimately, if I just invest in property, what's then going to happen? Well, it could be really good, and when it goes down in a big way. So I like to hedge, you know, if stocks go down, gold goes up. If money's out of fashion, Bitcoin goes up. A lot of different things sort of go into that, and I like to hedge my bets moving forward. Linking back to this stock section, I'm going to grab my phone in a minute and show you a breakdown of how it looks. But I will, as I'm growing my portfolio of stocks, remember this is of that 20%, never have more than 5% of my wealth in stocks in just one stock. So I'll invest in indexes, and I'll definitely have more than 5% in there, more like 10, 15%. But I'm talking about if you're going for individual stocks, because if you go for an index, let's say the FTSE 100, you are putting a bet on or investing in the top 100 companies in the UK. So in general, and if you're in America, the E-mini S&P, if you're in Hong Kong, the Hang Seng, the Nikkei in Japan, whatever it is, you're investing in the top companies in there. So in general, they all grow at a fairly consistent rate. And I'm going to break that down in a moment and how that works. But that's fine, but when you're on individual stocks, you really need to understand the sectors and not over leverage yourself. And again, caveat to this, if you're starting out, you're obviously going to have 100% of your money in stock. I'm talking about over the long term, you want to start breaking that down. Number 4 is be ready and don't get stung. And the way that we do this is, if you remember my breakdown 20%, I have 5% of my capital, my wealth, in cash. Now, if you've seen one of my other videos, the pot system, I talk about having a buffer. This is on top of that. I will have 5% of my net wealth sat there in cash in case everything falls apart. Now, I will be honest with you, I hate having that. I really do hate it. I don't enjoy having money in my account, believe it or not. I like getting it working for me. But ultimately, I want to be ready so that if the economy crumbles, I'm really excited about that. Not for people, obviously, but from an investment perspective, that's when I want to go into buying mode. And as Warren Buffett says, be greedy whilst others are fearful, and fearful whilst others are greedy. So when other people are fearful and the markets are crashing, I'm going to be greedy and pick up a heavy discount on my stocks and my investments, and you should too. Number 5, and this is really important, don't invest in what you don't understand. So I mentioned a really small part of my portfolio is in altcoins, cryptocurrencies, Bitcoin, Ripple, whatever it is. Neon's another one. but it's a very small part of what I invest in. It's incredibly high risk. And I'll be honest, I understand it to a certain level, but I definitely do not understand them enough to go all in. And what's really scary at the moment is people see it going up and up and up because it's fueled artificially by a load of people and some of the big sharks now out there, which is great. But they're investing in it and talking about something that they quite clearly don't understand, but are trying to convince themselves. Now, the problem with that is when it goes up a load, you think you're an absolute hero. But when it goes down, which I've done in the past as well, by the way, in the last rise when Ripple, I put in $40,000 into Ripple and it went down to about $5,000 within about 3 weeks. It happens, right? Because I broke my rule. I didn't understand what I was doing. My taxi driver was talking about what a great investment it was. People were talking around it and I got caught up in the hype, and it is a lesson I will not learn again. And I really hope you're listening to this and learning from my mistakes, not feeling the need to do them yourself. Okay, number 6, and this is a really important one, kind of going back to getting discounts and being ready, is buy damaged stocks, don't buy damaged companies. So a lot of people, you don't want to catch a falling knife, okay? If a stock is diving, don't just go, yeah, I'm picking this up at a great price. At the same time, don't just sell off, okay? You need to understand the business. You need to understand what they're doing. And if, a good example of this is Coca-Cola, by the way. Years ago, an announcement come out about somebody said they found like a fingernail in their Coke and they were going to give them a payout. And then somebody else was like, I found a toe in there, and it just got a bit ridiculous. And Coca-Cola was going to pay it out, and they said, you know what? No. There's a huge dip in the stock, but Warren Buffett was buying and buying and buying, but the stock was taking a nosedive because it had a damaged reputation, a damaged stock. It is not a damaged company. Then what they did is they invited health and safety to come in and see the procedure end to end because they were so confident that it was physically impossible for it to happen. Everyone agreed unanimously. They didn't need to pay out and the stock shot up, okay? So buy damaged stock, not a damaged company. Number 7, this is a big one, is don't be scared of taxes. If you have a stock that has gone up remarkably, you need to remember to actually take profit, because it's all on a piece of paper if you're not moving the money around, okay? So if you have a stock that does particularly well, you want to be able to exit that as much as possible, okay? So don't sell all of your stock if you think it's still got growth. But a lot of people will hold the stock because they're going to have to pay taxes when they sell it. But ultimately, if I went 10,000 in on Games Workshop and I'm at 20,000 right now, why wouldn't I take between £5,000 and £10,000 out? Then the 10,000 that's left in shares is pure profit money, okay? It's all winning there. And then have that 10,000, yeah, if you get taxed on it, it might become 8,000 or 7,000. But I've then got that to reinvest in another stock and carry on growing. So don't be afraid of the taxes. Number 8, and this is a really big one. This was originally from somebody called Benjamin Graham. He is the absolute god that passed away many, many years ago. If you've not heard of him, type him in on Google, Benjamin Graham. And in fact, I'm going to put a link to one of his books that I recommend down below in the description. Strongly recommend you get those principles, and it's called dollar cost averaging. So what you're going to see is a market going like this, the FTSE 100, okay? So FTSE 100 is the top 100 companies in the UK. And as an index, top 100 is an index, you will see it go something like this. And then this year happened in February. It went literally from about 6,000 to about 4,200. And then since then, of course, it's gone like this. And we'll continue to do that. The thing that you're trying to look at, if we go point to point, I'll try to make this as straight as possible. You see the general trend, okay? So time in the market will always beat timing the market. You can never time the market perfectly. Those are for losers. They think they've got it understood. No, it's never going to happen, okay? I'm going to say that again. Time in the market will always beat timing the market. And this is where Benjamin's a thesis around dollar cost averaging comes in is if you've got money to invest and you can do it consistently, you want to buy at those monthly or bi-monthly or quarterly or biannually or yearly, bi-yearly, decades, whatever it is that you can do, you consistently invest, because what you're looking at for the FTSE over an average 5-year period is 30%. Okay, 30% over a 5-year period, pretty decent. We're looking at 6% annualized across the cumulative impact of 30%. Now imagine if you tried to time that. Now, yes, of course, sometimes you might have put it all in there and then you might have sold there. And then you might have sold again here, sold the rest, bought there, sold there, bought there, sold there, and bought a hell of a lot here. That's what the technical traders will tell you. That's exactly what they've done. And they go bust 6 months later. The truth is, timing the market is such an exceptionally difficult thing. And not only that, the pros out there have algorithms and tech that will far outstrip your ability and speed that you're able to take advantage of this, because they're moving on mini pip movement. So they can buy and sell on that sort of movement whilst you're trying to deal with movements like that. Okay, don't compete with people that are experts and have the right algorithms and tech to help them time the market perfectly. Instead, accept what you can control, and that is going back to your time in the market. And if we go back to here, the longer you're in the market, the more money you're going to make money. Only 2 more to go, guys. I really appreciate your patience with this, and I hope it's adding a load of value. And if it is, please do hit the like button. It really does help with the YouTube algorithm. And of course, subscribe to the channel if you want to see more videos like this. So let's jump in with number 9. Don't invest for the sake of investing. And that seems like a really simple thing, but so many people will do it where they get £10,000 from selling something, or they've inherited some money, or they've sold a stock at a high price, and all the time they are looking to just go, get the money invested. And actually, it's something I always say is some of the best investments I've ever made, and I truly believe this, some of the best investments I've ever made are the investments I chose not to go in on, okay? Now, you can get emotional about taking snap reactions. That brings me on to number 10, tying it into this, is not investing money that you can't afford. Because when you get emotional, you make rash decisions, okay? So Warren Buffett has something called his sphere of influence. And what this will be is all these stocks, and I can't remember exactly how many he has. It might be like 30 or 40. And he just reads incessantly around it, okay? So when he believes in fundamentals investing, what that means is when he buys a stock, he believes in the company. He doesn't care if there's bad news, he'll just buy more. And he'll only exit when he really thinks he doesn't believe in the long-term growth in this. Arguably one of the most successful investors in the world, right? Not an emotional investor, an accurate and well-educated, well-versed and well-read investor. So when you're tying this in with not just investing for the sake of it, is you can start get quite smug, okay? So sometimes you can see, and I'll bring up my phone for this so you can see exactly what I mean. Sometimes you can get smug when an investment is doing really well, okay? And when you've got this investment, so if we're looking on my phone right now, this is of an ISA, okay? I put around, there's 2 years worth in this ISA, so there's about 40,000 in there. We're at 54,000 now, so it's gone up. And actually, this has gone up about £1,000 since yesterday, so this is the first time I've actually checked this. So let's see what's happened here. So I can look quite cocky and feel quite cocky here if I'm looking at my Games Workshop share. So I've actually taken out quite a lot of money up there, but Games Workshop, I'm up 48%. Countrywide, I'm up 36%. Can look like a pretty good investment, right? But if you base it on a day-to-day like that, I'm happy that that's happened, but I also don't really care that that's happened, okay? Because I'm not emotional about the day-to-day of this. I believe in the long-term investment of these stocks that are gonna go upwards. Because if I feel smug about that, then I feel pretty crap about Aston Martin, which is, I literally just put like 40 quid in there, shows I believe how much in that stock, right? But I don't, I just like Aston Martin, down 11%. If you look at Norwegian Cruise Lines, which I really do believe in and I'm testing right now, I'm down 11% on that. Let's see, I've got shares in JD, I'm up 28%. So I'm not emotionally investing in this, and I would never invest money that I cannot afford to lose. The money I'm investing in that is for my growth, and sometimes it's not going to go to plan because investment equals risk. Okay, and you really need to take those in. So I'm just going to stream through those quickly. Get your pen and paper ready to note this down. And just as you're grabbing that, I'm streaming through. Again, I really do appreciate if you can hit the like button and hit the subscribe and notification bell if this is the sort of videos that you want to see moving forward. Number one, invest as early as possible. The younger you are when you start investing, the easier it is to become a millionaire. Number two, never have more than 20% of your investment in any one asset class. And linked in with that, number three, if you're in your stocks and shares, don't invest more than 5% in any individual stock. Number four, keep a cash reserve. Be ready, don't get stung. Make sure you allocate a 5% side reserve of your cash so you're ready when the market is right and you don't get stung when it's wrong. Number five is only invest in what you understand. Please do not invest in things you do not understand. Number six is buy into damaged stock, not companies. Remember the analogy of Coca-Cola. Buy a stock when it's down in negative publicity, not when it's got crap leadership. Number seven, do not fear taxes. Remember, the money is only real when you take it out and reinvest it and build your portfolio. Please don't wait around because the stock will drop and then you'll get emotional, end up selling. Number seven, dollar cost averaging. And again, I'm going to put a link below to the book by Benjamin Graham. Remember, you cannot time the market better than your time in the market. Time in the market is going to be a hell of a lot more powerful. Number nine, don't invest just for the sake of investing. Make sure you're patient as possible. And number 10, don't invest what you cannot afford to lose. Otherwise, you end up investing with emotion, not an objective outlay. And I'm going to give you a bonus one and just go through it one more time, be extra cheeky. Smash the like button, hit the subscribe and the notification bell. If you found value in this, let me know in the comments. Let me know if there's more content you want covered. And as always, I'll see you in the next video.